What is up, guys? Welcome back to another video. So yes, today I am not in my typical studio because I'm on the road. However, I do have some exciting content in store. If you guys keep up with Reddit's Wallstreetbets, well, there was a post that gained a lot of traction recently. And it was titled, "The Bigger Short, How 2008 is Repeating with a Larger Magnitude." It essentially went into great depths in explaining how 2008 was a big financial crisis and how technically we're not necessarily out of it. And how the last year with the last illness wasn't necessarily a catalyst for the market crashing, and it could be a very big scenario just like 2008 where the entire market will melt down. And it's actually shocking about how this guy went into great lengths and in-depth on explaining how the scenario is going to play out. Honestly, it reminds me a ton of the 2015 movie The Big Short with Michael Burry and how he went through every single mortgage-backed security and bet on the complete housing market. So I want to dive straight into the video and explain how the 2008 financial crisis was a massive meltdown and how it's going to happen again in the near future. Long story short, the banks lent too much money to people who were unqualified in getting those loans. Then the bank took all those loans that were basically junk and turned them into AAA rated investments, which is the best ranking for investments, and they're considered super safe without any chance of really defaulting. Once they actually bundled all those really crappy mortgages into supposedly this really great investment, well, they went and sold it off to other banks and investors. Then they proceeded to go and directly bet against those investments that they just sold to those investors. The real estate market eventually crashed because all those AAA backed securities were really just junk. Everyone started defaulting and the entire market just crumbled on itself. Everyone lost tons and tons of money except for the banks that bet against those investments that they actually just sold, gaining tons of money and tons of power in the process without being reprimanded whatsoever. Now, I do not like to push any FUD on YouTube whatsoever because I don't really think it's a really good thing for the financial community. FUD stands for fear, uncertainty, and doubt, and this is why a lot of people make stupid decisions because they're scared about some investments. They put their emotions over logic and make some really dumb mistakes. Now, if you've watched the channel for a while, you probably know that I am a big advocate for consistently buying into the market and just buying into index funds because that is the best possible way to make millions of dollars with a limited amount of risk. But I really wanted to share this information with you because I found it really intriguing and very interesting to see how the 2020s will go. Now, yes, the 2020s are upon us, but I need to rewind the clock all the way back to the 1990s. And where we're going to be starting is the derivatives market. Derivatives were invented and started to be traded in the 1990s. Now, if you guys don't know what derivatives are essentially a bet on someone else's bet. So let's say investor one buys stock in Apple, hoping that the price will go up. Well, then on the side, myself and someone else will bet on his bet on the investment on Apple. Therefore, it's a bet on a bet, right? So now you're following me so far. However, they took that one step further, where someone can bet on my bet with another investor's bet on someone else's bet. And to make it even hairier, now you can leverage your bets, so therefore I'm taking out margin to bet on someone else's bet. And people can do that throughout the entire process, so you're taking out loans to bet on someone else's bet who's leverage betting on someone else's bet. The most well-known derivatives are call options and put options, and you've probably heard about those. Now, if you want to learn more about options and how they operate, I did make a video on that in the past, so link in the description below. Watch that after you watch this video. Now, essentially how they work in a nutshell is I bet with someone else that a certain price of a stock will hit a certain limit by a certain date. So let's say Apple is $100 and I bet that it will go up to $110 in the next 6 months. Now, if it doesn't go up to that price, well, I will lose my entire investment. However, if it does go above that price, well, I'll get paid 5 to 10x my money. The reason why is because I'm leveraging a lot of money on someone else's bet on the underlying stock. People can make tons of money, but people are also taking on tons of risk in the process. Warren Buffett, the billionaire and potentially the best investor of all time, he's actually talked about derivatives and said how he likes to stay away from them. Warren Buffett stated, "In our view, derivatives are financial weapons of mass destruction, carrying dangers that, while latent, are potentially lethal." So as you can tell, he is not a very big fan of betting on someone else's bet while leveraging your money, which is definitely understandable in looking at his overall view on investing being value investing. As you can see, any options trading or options investing is drastically different than any dividend investing or any index investing or any value investing, to say the least. You can lose 100% of your investment in just a couple of days if you just play it wrong. Let's say that you did buy that Apple stock at $100 just for simple math, and it did go up 5% in the next 6 months. Well, you would still be owning all your Apple stock plus the 5% that it went up over the last 6 months. Compared to the options trading, well, you would have lost your entire investment, and at the end of it, you have nothing to show. Now, this is where it gets really interesting for me because Bill Clinton came out with a commodities Futures Modernization Act of 2000. This essentially wiped out any regulation in the derivatives market if there was any at all. Therefore, the people now regulating the derivatives market is the federal government. However, the federal government regulates it under the Safety and Sound Act. Safety and Sound basically gives all the power to the big banks that failed us in 2008. And by definition, the Safety and Sound Act has a lot of gray area, essentially saying how the banks who failed us in 2008, if they just try their best in being fiduciaries, well, they'll look the other way and not even bat an eye, which then made the publicly traded markets a legal casino for anyone who wanted it. And if you could imagine, the derivative market took off. Here's a pop-up on screen showing the world GDP to the derivatives market, and this was actually in the Reddit post, which is just absurd how much it's taken off since the year 2000. Now, jumping back to the 2008 financial crisis, the banks that securitized these junk bonds into AAA investments will again bet against them. They've made tons of money in that process, while millions and millions of people lost their pensions, their retirements, and their livelihood. The world market cap is worth roughly around $90 trillion. However, with the recent stimulus in the past year, that could have been bumped up a couple trillion, give or take. However, when you compare that to the derivatives market, it is absurd. The derivatives market is estimated value around $640 trillion to $1 quadrillion, which is literally double to triple the value of the entire world wealth, which is estimated around $360 trillion. Now, how is the current economic climate? Very similar to 2008. Well, 2008 had to do with residential properties. However, now it has to do with commercial properties. There were studies that came out on a nonprofit organization who really dove down deep into this. And essentially, they came out with a conclusion stating that the banks who are giving these loans on these commercial properties are overestimating the revenue that they're actually receiving off this loan. And if they overestimate the revenue that they're actually receiving off these investments, well, that skews all the numbers and can really screw a lot of things up. And these investments are called commercial security-backed securities, aka CMBS, just for simple terms. These CMBSs have an estimated net value of over $600 billion, which again is just absurd when you compare that to the American markets. So a 10% misreport would be equivalent to $60 billion of lost value. But why are they doing this? And again, it's very simple. They are trying to make these CMBSs as attractive to investors as they possibly can. Very similar to 2008, how they did that with the mortgage-backed securities on residential properties. If they're more attractive to investors, well, they're easier to sell for the big banks and they make a ton of money off them. And people are saying that this could be a tipping point. And the reason why the entire market didn't melt down was because the US government social programs. A lot of money has been given out in the last year to US citizens, from stimulus checks and stuff like that, allowing them to pay their rent. However, if they weren't able to pay their rent, they would have defaulted on their loan. They didn't default on those loans, but let's say they did because the stimulus won't last forever. Well, the CMBSs will start defaulting, and that is the bottom of the pyramid. When the bottom of the pyramid starts crumbling, well, everything comes down with it. And a $600 billion market cap is large enough to make a massive dent in the publicly traded market. Let's say these renters will default on these payments, and well, everything will start to crumble down and everything will be dragged down with it. It's very similar to 2008, except it's just a different wrapping paper, and instead of residential properties, it's just commercial properties. I really appreciate you guys watching this video, and if you guys have any questions, just comment them down below. In the description, I'll send a link right to the Reddit post that I got a lot of this information off of, and of course, like, subscribe, comment for the YouTube algorithms, and I'll see you guys next time.